Good morning, everybody. We're here to discuss an agreement we've reached with Iberdrola to buy what I would describe as a sort of unique and complementary portfolio of generation assets. What I'm going to do is I'm going to go through an introduction and sort of talk through the outlines of the deal and why I think it's attractive. Ask Andy to talk through the portfolio in some more detail. Then we'll talk about how we plan to fund the transaction as well as the process, and then I'll come back to sum up before I'll open it up to questions. So again, as I said, we've reached an agreement to acquire a unique and complementary portfolio of pump storage, run-of-river, hydro, and gas generation assets, along with the people that have been running those assets. And I have to say, I think it's extremely exciting. It really gives us a very attractive portfolio of assets with which to play in this market. The transaction is fundamentally in line with our view of where the UK energy system is going. So moving to a situation where you have a combination of intermittent renewables, providing the majority of power, and then dispatchable power, which is actually going to be the smaller piece, but actually is the area where we will play. And I think there's a lot of opportunity, and I think will be very exciting. So what I'm going to do is I'll go through the strategic rationale, which I find very compelling, the financial rationale also quite compelling, and then I'll turn it over to Andy and to Den, as I mentioned before. Just to mention, this is a Class 1 transaction, and therefore subject to shareholder approval, and also requires approval from the CMA. So what are we doing here? Excuse me. We're buying a portfolio of pump storage, run-of-river hydro and gas. We're also buying the Daldowie biomass from waste pellet plant, which is up in Scotland as well. The total capacity is 2.6 gigawatts. I'm very excited about all of the assets we're acquiring, as they all contribute to our strategy of providing low-carbon dispatchable power. I think important to say that the pump storage and hydro represent the lion's share of the value, given the longevity with which we expect them to operate, whereas the gas will come off probably in the medium term. We're paying $702 million in value, and we expect the EBITDA of the target to be between $90 and $110 million in 2019. We are doing a formal profit forecast for the target, and Den will walk you through the details of that in a moment. The transaction is 100% debt funded, and we expect to be back down to 2 times net debt to EBITDA, which is our long-term target, by the end of 2019. And importantly, we're adding 260 excellent people, and Andy will talk a little bit about the times we've had to meet with them, and we've been very impressed with that team. So how does the acquisition line up with where we see the energy system going, both in the UK and more globally? So fundamentally, in order to hit a sort of 2 degrees sort of carbon or 2 degrees sort of climate change target, I think the world needs to be carbon neutral or net carbon zero by 2050. And if you look at the IPCC report that came out last week, they think that we can do that with an energy system or an electricity system that is about 85% renewables, by which I think they're focusing primarily on wind and solar, i.e. intermittent renewables, with still 15% of that system provided for by flexible but also low carbon energy sources, right? And I actually think so. Lots of people, rightly so, are going after that 85%, and I think fewer are going after that 15%, right? Now, over time, there will be lots of different technologies that will play there, i.e. lots of talk about batteries and storage, et cetera, which we think will absolutely happen. But there's going to be lots of room for what we're doing as well, right? So the run-of-river hydro, the pump storage, our own biomass, where we are expecting to get the cost of generation down to a point where it can be economic without support post-2027. We think all of those will play a very significant role in that system over time. And we think there's a real interesting and growing opportunity for Drax in that space. So again, we think they're compelling strategic benefits. We have increased earnings potential coming from that system support opportunity. We'll now have a nationwide portfolio of dispatchable assets, which you can see, I think, pretty well shown on that map. We also have a whole set of options and development options across that map as well, which Andy will talk about in more detail. It really fundamentally changes the shape of the group in a way that I think is very attractive for ourselves and also for our shareholders. We become a multi-technology generating business, not only biomass, but also now hydro and gas, which again has benefits from a portfolio perspective, but also real operational benefits in how we can actually offset the different types of generation and the pricing of the different types of generation in different market circumstances. We're a major low carbon player, but again, in the dispatchable space. So fundamentally, by taking control of our own destiny, doing this deal with the other projects we also have, which we also continue to be excited about in the repowering and the open cycles, it positions Drax as a major player in what I would call the dispatchable space. The deal, I think, has very attractive financial benefits. So 2/3 of the gross profit of the portfolio we're acquiring comes from what we call non-commodity sources. So that's a combination of system support, i.e. ancillary services, which is where Cruachan and the pump storage gets its earnings from index-linked ROCs and capacity payments. Dan will walk you through, for example, the capacity payments, £46 million expected there in 2019. And the Daldawi pellet earnings are also contracted. There is a fixed price for both the inputs and the outputs from that plant. So again, it increases the visibility and the quality of our longer-term earnings. We expect it to have attractive financial returns, where the returns significantly higher than our weighted average cost of capital, and we expect the deal to be highly accretive to underlying earnings in 2019. As I mentioned before, we have a debt facility in place to fund the deal and expect to be back down to our target of net debt to EBITDA of 2 times by the end of 2019. And importantly, we expect the rating agencies to reaffirm our ratings on the combination of the rapid deleveraging, but also because of the change or the reduction in the overall risk profile of the group. From a capital allocation perspective, we are committed to our policy of having a growing and sustainable dividend, and actually believe that this transaction will strengthen our ability to deliver that, and we expect to complete our current share buyback over the course of the rest of the year. So with that, I'll turn it over to Andy to talk through the details of the portfolio.
So thank you, Will. I just wanted to spend some time running through the assets that we're acquiring in a bit more detail. So as Will has mentioned, the bulk of the valuation and the future earnings is located in the hydro assets in Scotland. The largest of those assets is the 440 megawatt pump storage facility at Cruachan near Oban. Now this is an impressive asset. It has 4 units, each of which is highly flexible and fully reversible, and it can go from spinning reserve to full load in just 30 seconds. And what also makes Cruachan stand out is its storage capability. It has a reservoir that can be fed from Loch Orr below, but it also has some natural catchment areas, which means that all 4 units can run for up to 16 hours, which makes it a long duration storage asset, providing 35% of the UK's storage capacity by volume. Our belief is that pumped storage will play an increasingly critical role in helping the UK to decarbonise, given the wide range of services it provides. Historically, such assets have pumped water up to the reservoir at times of low power prices and used that water to generate power at times of high prices. But over recent years, Cruachan has been used to provide a wide range of system support services, either through contracts directly with National Grid or by responding in real time through the balancing mechanism. The units can each operate individually in one of 5 modes, providing services such as fast reserve, inertia, and frequency response, and they frequently switch between them as grid requires. And this flexibility is highly valued. On average, the facility makes 250 mode changes per week. Prices for these various services were actually increased early in 2018, and the plant has seen no diminution in demand, underlining its strategic value. It has also secured contracts worth £35 million in the capacity market through to 2022. So on to the other hydro assets, which are based at Galloway and Lanark and total 126 megawatt hours, comprising 8 small run-of-river power stations with a series of dams and reservoirs connected to Galloway, which provide additional storage. These are equally impressive. As well as qualifying for either renewable support under the ROC regime or capacity market revenues, the power stations are dispatched to capture peak power prices. The storage provided by the reservoir and dam system means the operators have a greater degree of flexibility and control as to when they run the stations, which means they have a greater ability to capture higher power prices or provide system support services. We would expect both sets of hydro assets to run for a very long time, given the fact they're maintained to a high standard, which we intend to continue. So moving on to the thermal side, the portfolio includes 4 combined cycle gas turbines or 4 large gas plants. The larger assets are at Damhead Creek, Rye House and Shoreham, and these provide large-scale flexible generation and are strategically located around London. Being situated so close to London, their grid charges are positive, so they're an actual income stream rather than a cost such as we pay at Drax based in Yorkshire, and they're frequently used to provide system support services. For example, Damhead Creek has had a frequency response contract for many years with National Grid and is regularly used in the balancing mechanism to provide energy or system services. Additionally, the plants have contracted £127 million of capacity payments through to September 2022. All of these plants are supported by long-term maintenance contracts with the original equipment manufacturers, and the thermal team have an excellent track record of managing those contracts over time to extract maximum value for the running regimes would have had to change. There's also a small 60 megawatt CCGT at Blackburn that comes with the portfolio. The final asset being acquired is a 50,000 tonne biomass pellet from waste facility that operates under a PFI deal with Scottish Water, with the pellets sold to Lafarge, and as Will said, this facility is fully contracted and actually runs through to 2026. If I come on to the other benefits, as Will has mentioned, there are a number of attractive development and expansion opportunities, including the new build CCGT project known as Damhead Creek 2, which would sit alongside the existing gas plant there, and there are a number of options also at Crooken. The plants also come with a full complement of over 260 operational people, and I've been very impressed with the team when we visited the sites during the due diligence phase. They demonstrated a strong safety and operational culture, a disciplined approach to investment, but with a real commercial focus on how to operate the units to optimise financial performance. The heads of hydro and thermal, who both come with a deal, are well used to managing their team as part of a portfolio, and the head of thermal, who runs the CCGT assets, actually did his apprenticeship at Drax and trained with many of the team who still work in Yorkshire. I'm therefore confident that there is a good cultural fit between the teams. We also believe that there are many other benefits from bringing the two portfolios together into a multi-fuel, multi-technology portfolio at Drax. Our trading team will be expanded to centrally manage and optimise the 6.5 gigawatts of assets now under our control. We understand that Scottish Power had often used the portfolio to balance their retail book or their intermittent wind assets, and therefore we believe we can drive more value from them collectively without that requirement. Furthermore, the addition of gas to our portfolio provides a natural hedge to our current exposure to falling gas prices on our RO-accredited biomass and coal units, bringing more stability to our earnings with immediate effect. We will also have greater visibility of National Grid's requirements to balance the system, with the portfolio geographically spread from Scotland down to the south coast. Finally, we hope to bring together two excellent engineering teams, making the most of the range of civil, electrical and mechanical engineers across the plants and taking the best in operating processes and practices across the new wider business. I'll pass you over to Den.
Thank you, Andy. As Will said, I'll be going through the funding, the process and an EBITDA bridge from 2017 to 2019 for the acquisition. On funding, the transaction will be fully debt funded. We have agreed a fully underwritten £725 million secured acquisition bridge facility. The term of the facility is for 12 months with a 7-month extension option and interest payable at a rate of LIBOR plus an applicable margin. The facility is competitively priced and well below Drax's current cost of debt, which is around 4.5%. With the facility in place, we expect to fund from a combination of cash and debt, and we are now considering our long-term funding opportunities and will update you during 2019. Net debt to EBITDA for the full year 2018, the current year, is now expected to be around 1.5 times before the acquisition. Taking this together with the acquisition's earnings and cash flow, the bridge facility, alongside our focus on an efficient balance sheet, we expect net debt to be in line with our long-term target of 2 times by the end of 2019. With the return to this target over such a short period of time and the move to a multi-site portfolio model, we expect the credit rating agencies to view the acquisition as supportive of the current rating and contributing to a reduced risk profile for the group. Now, in terms of dividends, there's no change here. We remain committed to paying a growing and sustainable dividend. We also remain committed to completing our current 50 million share buyback programme, where we've bought 32 million of shares. Now, in terms of the process on the acquisition, it's conditional on the CMA and shareholder approval, as Will has said. To that end, we will send a Class 1 circular to shareholders as soon as practically possible and expect to hold a general meeting and vote during December 2018. We hope to complete the acquisition on the 31st of December 2018. Just want to say a few words here on the profit forecast here. As Will has said, we expect the portfolio to generate EBITDA of between 90 and 110 million in 2019. Around two-thirds of this EBITDA is expected to come from non-commodity market sources, including system support services, capacity payments, ROCs, thus providing high-quality earnings and long-term earnings visibility. I'll now take you through a bridge, as you can see on the slide, of how we get to this forecast. If you start on the left with the 2017, where the full-year EBITDA was 36 million, and from this we have 4 key areas that drive us to the range. The first is an increase in capacity payments of around 42 million. It's worth noting that over the next 4 years, the portfolio will receive around 170 million of payments. Secondly, removing a 2017 grid restriction, which is around 8 million. Now, this was a grid issue and not an issue with the portfolio that we're purchasing. We also expect corporate overheads and recharges to be lower. We estimate this to be around 9 million lower than the current allocated overheads. Lastly, if you take these points, together with growth in system support and revenues from current power prices, and add these to 2017 actuals, you get very comfortably into the range of 90 to 110 million. And with that, I'll hand you back to Will.
Thanks, Dan. I was told that the webcast may have started a little bit late or after I began, so I'll just bear with me. I might just go over the summary again briefly. So again, we're here today because we've reached an agreement to acquire a unique and complementary portfolio of assets. It's actually the same slide, so it doesn't work too badly. Pumped storage, run-of-river hydro, and gas generation assets from Iberdrola, as well as the teams that have been running those facilities. Again, as I went through in my slides, we think the transaction is fundamentally aligned, both with our own view of the UK system and then how we expect to play in that system. Right? And I think our strategy is fundamentally to focus on that 15% of the system that in the long term will be still dispatchable power provided by a combination of technologies that we can provide, i.e. the biomass long term, the pump storage that we're acquiring here, the run-of-river gas, and in the medium term, the run-of-river hydro, and in the medium term, the gas assets. We think there's a very attractive opportunity in a market which we think will be growing and provides an interesting combination of both contracted earnings, but also access to upside as the market becomes more volatile. So we think we have a very compelling strategic case, a strong financial case, and as Dan has been through, we'll be looking to get shareholder approval before the end of the year. So thank you, and with that, I will turn it over to questions. If you let me know the questions, and for the benefit of the people on the webcast, please let me know, your name and where you're from, and then I'll take the questions and hand them out to the team. Any questions? Ian? Yeah.
Is there a mic?
Yes, there's a mic, sorry.
Yeah, it's Ian Turner from Exane. Can I just ask how you would split the price between the assets that you're buying today? And not down to the last penny, but roughly where you think the value is. And then, what will this look like in terms of depreciation going forward?
Yeah.
What sort of depreciation charge would you expect?
So when I
And then
take the first
finally,
one-
if I can, as I'm
Do you want me to do the depreciation one?
Yeah, go on.
I mean, basically, if you take the capex, it's just going to be on an annual basis of between 30 and 35. It's just slightly lower than that. Yeah, I'll take the easy one.
Did you have a third question?
Yeah, just in the long term, there seems to be lots of excitement around battery technology at the moment, which potentially has the ability to be very competitive in some markets for pump storage. I just wondered if you had any comments on that.
Sure. So let's start with the first one. In terms of the value, again, I think, let's talk about the profile of the assets first, right? I think that it doesn't make a lot of sense to think about capacity because, first of all, the pump storage is very much ancillary services, right? And that is a big chunk of the value. The run-of-river hydro, again, because it runs, we can run it sort of almost not quite as a peaking operation, but because of the way the dams and reservoirs are set up, we actually should be able to get a higher than base load price for that. So it has I would say, significantly higher earnings than you would expect just from a plant of that size, plus the capacity payments, et cetera. So those two, form the vast majority of the value, right? And then the gas, producing a lot of earnings now, given where markets are. We would expect that over time to come down, again, as they run out of merit, right? Over different lives for different assets, but 5, 10, 15 years. So fundamentally, this is mostly about the water assets, really. Yeah. In terms of batteries, I mean, the thing about, I think, Cruachan and the ancillary services that it provides, one is the longevity of it, right? Or not the longevity, the amount of time that it can run, right? So you have 16 hours of stored power there, which is much longer than most pump storage facilities, huge amounts longer than any of the batteries would have today. So with the size of it, both in terms of how many megawatts it can produce, but the megawatt hours, is a very differentiated feature there, right? The other thing I would say is that from a capital perspective, it's effectively sunk cost, right? Very low operating costs, no marginal costs effectively. So the ability to actually, yes, batteries will become better and more effective over time, but I don't expect them to get anywhere near the capabilities of what we're doing for a long, long time. Actually, why don't you just pass the mic back when that's here.
Yes, Amit Farman, Jefferies. So just firstly, given the size of the asset, as you highlighted, it'll make you multi-fuel spread across the whole country. I just wonder how have you thought about sort of the operational and management challenges that will come together with such a large, sizable portfolio? I think you talked a little bit about that with bringing over the team from the Scottish Power assets, but I'm just interested in understanding a bit more about that. Then the other point, just a bit about the 90 to 110 EBITDA. I think it says in the press release that this is before overheads. So I just wanted to understand if there is any sort of significant overheads you expect with that.
So first, just to be clear, the 90 to 110 is not before overheads. That would be EBITDA as you would expect, EBITDA fully loaded, right? So I'm not sure whether, we should find out where you've seen that and make sure it's clear, because there's no further overheads to be applied to that, right? That's the first one. So I'll start on the other one and then hand it over to Andy. But so fundamentally, this will become part of our generation business, right? What we're getting as sort of the people who run the assets, so very comfortable that these guys know exactly how to do what they're doing. And the question will be, how do we integrate them into our team? So Andy, you want to talk about how that's going to work?
Yeah, so we're working on the integration plan now, and I'm confident we can move from single site to a multi-site, multi-fuel technology portfolio. So the teams that we're acquiring, as I mentioned, are used to working within a portfolio. So they're used to being sort of centrally dispatched by a trading team. And our trading team are also very used to running a number of assets. So the key will be, obviously, day one, bringing the assets on, making sure they run smoothly, continuously, safely. Over time, what we want to do is dispatch those as a portfolio. As I mentioned, there are various things that we can do. There's a nice gas offset on the CCGTs with our exposure on the RO and coal units, and therefore we also have system support services as well, which we'll have greater visibility on. So I'm very confident that, give us some time, but we can start dispatching this as an efficient portfolio across a range of technologies.
Hi, it's Jenny Ping from Citi. Two questions. Firstly, just on the strategy of the business. Now you've made this acquisition, what are your thoughts as you look forward? Are you still in the market for additional assets? Clearly not asking for which, but just as a principle. Are you interested in further thermal as well as renewable assets, potentially looking at onshore wind? Is that something on your agenda? And also specifically on the rockable assets in terms of run-of-river, can you give us a bit more details on the capacity eligible for ROCs and what ROCs you're getting for those capacity? Thanks.
So why don't I take the first one and then Andy take the second one. So in terms of the strategy, again, a couple of points I would make there. One is that in terms of generation, we're very much focused on this dispatchable portion of the market, right? So the ability to actually own assets that are low carbon or effectively renewable that actually can be dispatched, i.e. when there's no wind and no sun. So I think it's unlikely that we'll move into into wind or solar at this point, right? In terms of doing more acquisitions, I mean, fundamentally we've got a ton of work to do to get this one done, to get it integrated properly. So that's what we're focused on.
Okay, and in terms of the rockable assets, there's about 45 megawatts of the run-of-river hydro that qualifies for ROCs. It gets one ROC through to 2027, and the rest qualifies for capacity market payments.
Yeah.
Hi, it's Alex Wheeler, RBC. Can you talk around your views on the capacity market and whether you're assuming a recovery from the most recent auction levels?
So I think the answer to that is that I'm not going to make any sort of estimates about where I think it will be this coming year. I think that over time, I do believe that the system is going to need new generation capacity built. We've got a couple of very exciting projects that we want to do in that space. So very excited about the repowering at the power station as much as we have been, and that's the DCO process is working well there, and the economics are looking attractive. Same is true for our open cycles. Again, continue to see those as quite attractive. Whether it clears this year is not necessarily the key question for us. I mean, the question is we think that it will clear at an attractive price at some point going forward, and we'll be ready when it does.
Verity Mitchell, HSBC. I've just got a question about Damhead Creek. I mean, you've obviously got another opportunity here for expansion. How are you thinking about that, and how does that line up, bearing in mind that you said that it has positive grid access? Is that another new build we should be thinking about?
So I think the way I would describe that is that what we're acquiring is really a set of operating assets, right? And frankly, all of the returns and the discussion we've been having about returns is fundamentally based on what's actually running today, right? In addition, there are a series of development options that come with it. So there's Damhead Creek 2, there's an expansion opportunity at Shoreham, there's another expansion opportunity at Cruachan. So there's a lot of opportunities to do more things. And we add those into the portfolio of expansion opportunities that we already have, right? So what we will do is when we actually have sort of all of that portfolio sort of in our hands, we need to look at those and effectively assess them based on the relative merits, right? So it'll be all about risk and return, and we will be very disciplined in how we look at those. It'll also be about how much capital we have available. So there's no question for the next year we need to get our leverage back down to where we want it to be, right? But I think we'll look at in the round and say let's judge the projects on their merits and then do them if and when we think they're both within our capacity to execute upon effectively, and also the returns are good. Any questions from the webcast? Any more questions in the room? Great, well, we will be here if you want to ask questions offline, or available all week if you guys have more questions. Thanks everyone for coming, and just reiterate, I am extremely excited about what we're doing here, so thanks for coming.